This is the only indicator in TradingView that I can recommend to you. Because number 1, it doesn't repaint, and number 2, it works all the time. Therefore, I will reveal the best Fibonacci entry setup, a strategy widely used by central banks and financial institutions to secure profitable trades. If this is something you have been looking for, join the family by subscribing to this channel. So, let's start by understanding Fibonacci levels. Fibonacci levels are key areas where prices find support or resistance in the market. These levels mark the end of corrective moves and the continuation of existing trends. The Fibonacci levels commonly used by smart money are 0.382, 0.5, 0.618, and 0.786. Before anything else, let's all understand about the basics of smart money concepts. The market moves in two phases: impulse moves and correction moves. 1. Impulse moves. In this example, in an uptrend, these are large, imbalanced candles pushing the price upward. Traders buy en masse, creating sharp moves to the upside. After impulse move, price makes a pullback, which are called corrective moves. 2. Correction moves. Following impulse moves, the market pulls back as traders take profits, leading to a temporary drop in price. The correction ends when buyers regain control, and the price resumes its upward trajectory. In a downtrend, the process is reversed. Traders initiate short positions, creating large bearish candles. When the market pulls back, some traders buy, thinking the price is oversold, leading to a corrective move before the downtrend resumes. Now, why use Fibonacci levels? Fibonacci levels help identify where corrective moves end and new impulse moves begin. This enables traders to enter the market with a favorable risk-to-reward ratio. The most respected retracement levels are 38.2%, 50%, 61.8%, and 78.6%. Now let's have examples trading with Fibonacci retracement levels. Let's look at a bullish example with the euro to pound sterling chart on a 1-hour time frame. 1. Identify the trend. The market is in an uptrend, forming impulsive move to the upside and made a pullback or corrective move to the downside that we focus to the impulsive move to look for entries in the market. 2. Plot Fibonacci levels. Draw the Fibonacci retracement from the recent swing low to the swing high. 3. Wait for a pullback. Wait for the price to pull back to key Fibonacci levels, 50%, 61.8%, or 78.6%. 4. Enter the trade. As the price reaches the 61.8% level, enter a buy position. 5. Set risk to reward. Use a 3-to-1 risk to reward ratio. And price really followed our direction. Let's have an example when the market is on downtrend. For a bearish example, with the Euro/NZD chart 1-hour time frame. 1. Identify the trend. The market is in a downtrend, forming impulsive move to the downside and making a pullback to the upside. Focus on the most recent impulsive move to take trades. 2. Plot Fibonacci levels. Draw the Fibonacci retracement from the lower high to the lower low. 3. Wait for the price to pull back to key Fibonacci levels, 50%, 61.8%, or 78.6%. 4. Enter the trade. Enter a short position at the 61.8% level when a bearish candle forms. 5. Set risk to reward. Use a 3-to-1 risk to reward ratio. And as you can see, the market followed our direction. It is important to note that when trading in a strong uptrend, it is not necessary to wait for the market to pull back to the 61.8% Fibonacci retracement level before initiating a trade. The market may retrace to the 38.2% or 50% Fibonacci levels and then continue its existing trend. This type of retracement is known as a small pullback. Small pullbacks often occur when there are aggressive buyers in an uptrend or aggressive sellers in a downtrend, indicating that the market is strong. Conversely, a deep pullback occurs when the market retraces below the 50% Fibonacci level, suggesting that the market is weak. You might wonder at which Fibonacci level you should enter the market to ensure a profitable trade. To answer this, we need to understand the concepts of premium and discount zones in the market. Let's consider an example. Suppose the market is in an uptrend. To understand the concepts of premium and discount zones, we focus on the recent higher low and higher high. We draw the Fibonacci retracement levels from the swing low to the swing high. Premium zone, when the price is above the 50% Fibonacci level, it is considered to be in a premium zone. Entering the market in this zone might result in losses because the market often creates liquidity zones to trap retail traders before continuing its trend. Discount zone, when the price is below the 50% Fibonacci level, it is considered to be in a discount zone. Entering the market in this zone provides a better risk-to-reward ratio because the market is more likely to resume its trend after reaching this level. Let me hope that is understandable. Now, there is advanced strategies you can use when using the Fibonacci tool to become more profitable. The first strategy involves using multi-timeframe analysis in conjunction with Fibonacci retracement levels. Multi-timeframe analysis means examining two or more different time frames to get a comprehensive view of the market. The goal of this strategy is to enter the market when it creates a pullback. Let's explore this strategy with a detailed example. Consider the euro to Japanese yen chart on a 15-minute time frame. We observe that the market is making higher highs and higher lows, indicating an uptrend. The market then makes an impulsive move to the upside. To analyze this, we draw the Fibonacci retracement levels from the higher low, formed before the impulsive move, to the wick of the higher high. With the Fibonacci levels now plotted on the chart, we wait for the price to pull back to one of these levels. In this example, the market retraces to the 0.618 Fibonacci level. At this point, we switch to a higher time frame, such as the 1-hour chart, to confirm if the market is in a clear uptrend. On the 1-hour chart, we see that the market is indeed in an uptrend, as it continues to make higher highs and higher lows. With this confirmation, we return to the 15-minute chart and initiate a buy trade. We set our risk-to-reward ratio at 3-to-1. As the trade progresses, the market respects the uptrend and moves in our favor, resulting in a profitable trade. By combining multi-time frame analysis with Fibonacci retracement levels, we can effectively identify and capitalize on pullback opportunities in a trending market. Let's have another example for better understanding. Here, we have the euro to US dollar chart on a 15-minute time frame. Observing the chart, it is clear that the market is in a downtrend, as it is making lower highs and lower lows. To initiate our short trade, we focus on the recent impulsive move downward. We draw the Fibonacci retracement levels from the lower high, formed before the impulsive move, to the bottom wick of the lower low. With the Fibonacci levels in place, we wait for the price to pull back to one of these levels before initiating our short trade. In this instance, the market pulls back to the 0.618 Fibonacci level. At this point, we switch to a higher time frame, such as the 1-hour chart, to verify if the market is also in a downtrend on the larger scale. On the 1-hour chart, we observe that the market is indeed forming lower highs and lower lows, confirming that the market is in a downtrend. With this confirmation, we return to the 15-minute chart and initiate a short trade from the 0.618 Fibonacci level. To manage our trade, we set our risk-to-reward ratio at 3-to-1. As the trade progresses, the market respects the downtrend and moves in our favor, ultimately resulting in a profitable trade. By combining multi-time frame analysis with Fibonacci retracement levels, we effectively identify pullback opportunities in a downtrending market, leading to successful and profitable trades. Having learned the first strategy, let's move on to the second strategy, which involves using flip zones along with Fibonacci retracement levels to take entries in the market. Before diving into the strategy, let's understand some basics about flip zones. Order blocks are not always respected by the market. Sometimes, the market creates large imbalanced candles at the order block zone of the opposite direction and then continues its trend. Flip zones are areas where the market switches its role from support to resistance or vice versa. Now, let's learn this strategy with an example. Here, we have the Australian dollar to US dollar chart on a 1-hour time frame. We can see that the market formed a flip zone, indicating a higher probability of the price moving upwards after returning to this zone. To proceed, we draw the Fibonacci retracement levels from the candle that formed before the impulsive move to the wick of the higher high candle. Next, we wait for the price to retrace to the 0.236 Fibonacci level to initiate our buy trade. Once the price reaches the 0.236 Fibonacci level, this becomes our entry point. We set our risk-to-reward ratio at 3-to-1. As the trade progresses, the market respects the flip zone and Fibonacci level, leading to a profitable trade. Conclusion: by mastering these strategies, you can leverage Fibonacci levels to make profitable trades. Stay tuned for more advanced techniques in our next video.